how's it going? Alex from Macio. If you don't know me, now you do. I am a local Orange County real estate agent, and today I'm going to be talking about 3 factors that play a role in getting a loan and how much you can borrow. The reason why I'm making this video, guys, is because I've been getting a lot of questions from buyers interested in the market who want to know how lenders decide how much they are able to borrow. So the first reason here, reason number 1, has to do with your FICO score, right? So typically for a conventional loan, your FICO score should be around 620. Now, if it is a government-backed loan we're talking about here, we're talking about FHA, these requirements are going to be lower. Now, I will say that this FICO score is not the only way that lenders are going to determine how much they give you. So if your credit isn't perfect, don't sweat it. Reason number 2, income. That's kind of an important one, right? So the bank wants to basically see your average income for the past 2 years, right? So they're gonna look at pay stubs, they're gonna look at tax returns, and typically speaking, they're gonna look at 2 months bank statements. And as long as everything is supporting the amount that you wanna borrow, no problem. Reason number 3, DTI ratio, otherwise known as debt to income ratio. All right, guys, so the third main factor here is, like I just said, your debt to income ratio. And I know what you're thinking. You're like, what the hell is that? Why does it sound so complicated? It's not. Let me break it down for you and simplify it. So basically, look, the bank just wants to make sure that they're going to get paid back and that you're going to be able to afford this loan, right? So let me give you a very general example here. Your friend wants to lend, or wants $100, right? He wants you to lend him $100. You know for a fact he's got no job, no income, no motivation. Well, you're never gonna take that loan because you know that you're not gonna get paid back. So the bank or the lender operates in that same fashion, right? So they're gonna look at your income. Here's an example of some numbers, right? So let's just say that you earn $10,000 per month. Not bad, right? $120,000 per year. So on average, the bank is gonna allow a debt ratio of 43% of your monthly income. So if we do the math here, 43% times $10,000, what do we get? They're gonna allow a max of $4,300 in debt per month, okay? That said, more specifically here, these lenders want the mortgage to only be 28% of your debt. So if we do the math, 28% of $10,000, what do we get? That's $2,800. So that's typically the guidelines of how they're gonna lend you the money. Now there are exceptions. Let's just say that you happen to have no debt, you have no personal loans, no credit cards, no car payment, you don't pay rent because you live at home. Well, guess what? If that's the case and you have good income, then that 28% threshold is probably going to be increased, and the bank is probably going to let your mortgage be 30, 35, maybe 40% of your total debt because you don't have anything else that you're paying, if that makes sense. So, that said, guys, look, the lender wants to lend you the money. They want to make it work, but they also want to make sure that you're going to be able to pay back the loan and be comfortable, and it's going to not make you completely house poor, right? So that said, that's the basic lesson on debt to income ratio and the 3 main factors that play a role in how much you can get lent. If you have any other questions or maybe some more specific questions on this topic, feel free to reach out to me, 714-948-3570. I'm here 7 days a week for you. That said, it's the week before Super Bowl. Let's go out there. Let's crush it. Let's do our thing. I hope to see you out there, guys. Have a great week. Peace.